Wall Street Week with Louis Rukeyser. Brought to you by public television stations and by Hilton Hotels, America's business address, and its subsidiary Conrad International Hotels. Competition makes American business excel. Prudential Beach Securities, the investment firm with rock-solid resources that's leading the way to the future for investors. And the Sperry Corporation, providing high-technology, computer-based systems solutions to the complex problems of business, government, and defense. Produced Friday, March 14. Our panelists are Eddie Brown, Bernadette Murphy, and Carter Randall. Tonight's special guest is Will K. Weinstein, Managing Partner, Montgomery Securities.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when the records on Wall Street began to sound like broken records. I mean, as the host of the country's most widely watched program on the economy, I'd like to talk about something else for a change. The budget, for example. Though, alas, absolutely nothing seems to be happening there. Or perhaps real tax reform. You remember that vanished dream, don't you? Or at least the price of potatoes in Patagonia, which is, as usual, too high for the consumers and too low for the farmers. But no, Wall Street won't stop showing off and grabbing center stage. If it doesn't stop soon with this same old boring, week after week, record-breaking stuff, I'm going to have to start leaving a wake-up call for Friday nights. Just take this week. I'd rather talk about something uncertain and unpredictable for a change, like the new baseball season, or what embarrassing thing the Reagan children are going to do next. But how can you ignore the biggest weekly gain in the history of bean counting? Nearly 93 points in the Dow Jones Industrial Average. Not to mention new highs in prices and in volume on every market and in every index we keep track of, with the possible exception of the number of freckles on your stockbroker's children. Talk about tedious. Why, the big show-offs, having just set a record by soaring from 1,600 to 1,700 in a mere 3 weeks, tried to top themselves by almost turning in a 100-point week. In fact, if they just keep up this week's pace, according to some terribly important figuring I've just done on my pocket calculator, the Dow Jones Industrial Average will break 2,000 on, would you believe it, April Fool's Day, which may in truth say it all. As usual, of course, amid this week's razzle-dazzle, the woods were full of people saying it couldn't happen, as it was happening. And indeed, a new burst of pessimism hit the stock index futures late Friday, suggesting that a lot of people were looking for a big sell-off Monday. But the long-term predictive value of those wise guys has generally proved to be somewhere south of a used Ouija board. For this past week, in any event, the market was overshadowing everything else in sight, notably including the economy, whose performance lately has been in fits and starts, with the emphasis this week on the fits. Retail sales fell for the second month running. Industrial production took a dip. Auto sales slipped, and the trade deficit set yet another gory record. But you couldn't scare Wall Street. Putting these anemic economic figures together with the oil-powered decline in producer prices and some hints that the money supply may be coming under control, traders figured it all meant still more good news ahead on both inflation and interest rates. Well, it seems a good time to step back about 3,000 miles and talk with a guest with a California perspective on Wall Street. But first, let's look at the show that keeps trying to top itself in the ever more giddy world of Wall Street. And as the Dow Jones Industrial Average indicates, most of the noise-making came on Tuesday and Friday, when the Dow rose 43 points and 39 points, respectively, for two of the three biggest days ever for the Dow, and the blue chip index finished at an all-time peak for the 16th time this year, 1792.74, up an astounding 92.91 points for the week. Volume and point records tumbled for all our other major indexes as well, as investors rushed to buy blue chips, red chips, white chips, and possibly even potato chips. Has it all gone a bit far? Well, our elves have now lowered their technical market index 2 notches to -3. Still 2 notches above what they would call a signal to sell, but their lowest since they reported -4 January 3rd, after which the Dow fell 47 points in 13 sessions before resuming its record advance. It was a relatively unexciting week for gold, silver, and the dollar, but a historically volatile one for bonds, as traders tried to figure out how much steam was left in that stunning rally. After a week like this one, we all need to cool down, but we may have to do it one at a time. For Popsicle Industries announced this week that it will be replacing its traditional 2-stick treat on supermarket shelves with a fatter 1-stick model. People, it seems, just don't share like they used to. Carter Randall, let's share your view on this show-off market. Are we all now going to get as rich as Ferdinand Marcos?
Oh, I hope so, but I hope we get to keep it. Lou, this market, although very strong, as you point out, really should not be a surprise. There has been a lot of good news. We're doing a lot towards the federal budget deficit. Interest rates are coming down considerably. We're going to have growth in the economy, particularly as spendable income is increased by oil decreases, and we're really headed into maybe a short-term deflation area. That's very good news.
But markets never go straight in any one direction. Surely at some point this one has to rest, doesn't it?
Well, the old axiom, no tree grows to the sky, of course, but we haven't hit the sky yet. I think there's another 100 points or so on this, just for the market to be in
does that in a week?
equilibrium.
You expect that next week? Or?
Well, I don't expect that next week. No, I really don't, as a matter of fact. But I think there's another 100 points or so on the upside here. I must admit, I'm beginning to get worried about the end of this year.
Mm-hmm.
We're well into an economic recovery, and I really think 1987 might be a lackluster year in the economy, and the market may begin to anticipate it later on this year.
Bernadette Murphy, as the only avowed technician here tonight, we count on you to tell us whether you agree with those elves that things are getting a little bit more tacky.
It is frothy. However, I think that we probably have another few weeks, and the reason I think that is because we're coming into the point of the year, the time of the year, when money flows into the IRAs and KIOs, and it's clustered in the last 2 weeks in March, and first 2 weeks in April. And it's estimated at approximately 20% more money will go into stocks this year than in other years. Also, we're getting a shift in by the managers of large funds of money. They're changing their balance from 50% bonds and 50% stocks to more equities. And that shift has been taking place, and I think it'll go on for a little while longer, at least till the end of the quarter.
Do you have an interest rate forecast for us?
An interest rate forecast. At the present time, in looking at my indicators, I still see a fair amount of shorting going on in the futures on options in bonds, which would mean to me that there's still too much pessimism around, and we may actually have a little bit lower level to reach yet in yields.
Your system is based on contempt for the experts, is that right? Whatever they're doing is probably wrong.
Well, when they all do it together.
Ed Brown, there's a meeting of OPEC this weekend. I'm not going to ask you to tell us what's going to come out of that, but how important is something like that to the market like this?
Well, I think it's very important. The market has been anticipating continued, at least leveling off perhaps, in oil prices. And if they get together and decide to stabilize and maybe increase them a little bit, I think that would be a negative.
That may have been what some of the late-day pessimism in the futures market was all about.
I think so.
What do you think of this market in general?
I think people should stay on top of their portfolios. It's time, I think, to begin to look over your shoulder, or maybe look down the tunnel to make sure the light is not a train. I don't think it's over, but I think that...
Would you sell some things at this point? What sort of thing would you sell?
What I've been finding is that more and more securities in my portfolios are beginning to reach what I consider full valuation. And what I would be looking for is things that are selling at pretty rich price-earnings ratios in relation to their growth rates. But what I'm also finding when I begin to do that is that I'm finding other securities that are very attractive. So I'm not shifting into reserves out of the market.
Is there a particular type that you're now looking at? What's the type that has not?
I think there are kind of two areas that are very attractive at the moment. I think the property casualty companies are still attractive. People can look at their insurance rates for their homes or businesses and see that the companies should be improving earnings dramatically. I think that group is very, very attractive. I'm also looking for ways to play kind of the tremendous decline in interest rates and mortgages and the tremendous pickup in housing activity, even sales of existing homes. And I think some of the building retailers are very attractive.
All righty. This is the point in the program when we usually pause to answer a round of viewer questions. Tonight, though, we'll be surrendering those minutes to your local public television station so that at the end of this program, the folks there can turn to you for some much-needed financial assistance. But next week, we will be back to taking your laundry. So if you have any pressing money questions, want to iron something out, or just want to say a clean hello, drop us a line here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at the latest profile of the average American stockholder and see how, despite what they told you in the 60s, it was actually Wall Street that in the 1980s turned out to be bringing power to the people. According to a recent survey by the New York Stock Exchange, the number of Americans directly owning stocks has risen nearly 50% since 1981 alone, from 32 million to a record 47 million. Moreover, American women, who uncharacteristically, but perhaps wisely, had dipped to a minority of stockholders in those darker days, have been back in force as stocks rallied and now represent 50% of the total. 5 years ago, 14.4% of Americans, about 1 in 7, owned stocks. Now it's more than 1 in 5. And if you add in indirect ownership of stocks, such as through pension funds, you wind up with more than half the entire population. With so many new investors coming aboard, the typical portfolio has not grown as fast as the record-setting indexes. The average holding was just over $5,000 in 1981 and was about $1,100 higher in the latest survey. In 1983, the big board began breaking down where stockholders invest. It found then that nearly half invested exclusively in New York Stock Exchange stocks, about 10% solely in over-the-counter Amex and regional listings, just under 11% only in mutual funds, and the remaining 29% in more than one of these places. By last year, though, there were some interesting changes. The number of stockholders using only big board issues slipped to 47%. The combined over-the-counter Amex and regional share held about steady, and just under a quarter of stock investors put their money in more than one place. But the big jump, indicative of many new investors, was in those dealing exclusively in mutual funds, now more than 17% of the total. And what do all these shiny new capitalists have to look forward to next? For some thoughts on that, let's go over now and meet tonight's special guest, Will K. Weinstein. Willie, welcome. Nice for you to be with us.
Pleasure to be here, Lou.
At 45, Will Weinstein has already had a couple of impressive investment careers, plus 7 years in between living the good life in Sun Valley, Idaho, and recharging his batteries after being the trading chief at Oppenheimer and Company. 4 years ago, he joined Montgomery Securities in San Francisco, where, as the managing partner, he has a key voice in that firm's nationally influential stock selections. Willie, the Dow's now up more than 1,000 points from its 82 lows. For the last year, which is about half that rise, you have occasionally been quoted as being a little cautious. What will it take to make you a believer?
Not what's happening now. Excuse me. I think what we were was not so cautious. It was that we wanted to be very selective, and that was equally wrong as being cautious.
They threw out they build up the good girls and the bad girls, as the old saying goes.
And a very funny piece came out from someone at Merrill Lynch about the Revenge of the Nerds, which you may have seen. suggesting that this has not been a market where selectivity counted at all.
Okay, forget yesterday. Let's focus on tomorrow. Where are we now?
Well, I think we're in a little bit more precarious position than your panelists indicated, at least in the short term. I by no means think the game is over, but I do think that that it's wise to consider taking something like 30% of your bet off the table. And I think I would take that money and keep it in cash. I think I might keep it in some very short-term instrument. But I would want to have that money available.
Like a trumpet?
Sure. Some trumpets.
I mean like treasury bills or money market funds?
Yes,
huh?
yes.
Okay, what would you sell?
Well, I would sell the I stocks. Those are the interest rate stocks, the interest-sensitive stocks. They generally are the stocks that where the earnings are really very predictable. But what isn't predictable is what the market is going to pay for those earnings, and that's almost always a function of
Banks,
interest rates.
savings and loans, financial services companies?
Financial services companies, utilities, the consumer staple stocks, stocks such as possibly Coca-Cola, Pepsi-Cola, stocks like that I think have gotten ahead of themselves because I don't think that the dynamic is there in terms of their earnings, and I'm looking for earnings dynamics.
Okay, you'd sell about 30% in these areas you just mentioned. You'd put it in interest-bearing short-term paper. Would you buy any stocks?
I would, but I would after the market makes some kind of an adjustment. I think that the market will and should adjust to this frothiness that Bernadette mentioned, and I
How much of an adjustment are you looking for?
Well, I think it could be fairly substantial because I think that this move, of course, is unprecedented, but I think that it could be something like 200 or 200 plus points.
Where will you be looking at that point?
I would be looking at those stocks that are most influenced by the cycle in the economy. Those stocks where the earnings will explode. Those stocks that have been very inefficient, those companies, I should say, that have been very inefficient in the down part of the cycle, where the earnings were much worse than you would have expected. I mean, they were terrible. They were a disaster.
Such as?
Such as technology companies, some West Coast companies. National Semiconductor is, to me, an excellent example because this is a stock that when the rally began was selling at about 14, and it's still selling at 14 with the market up 500 and some odd points.
But you wouldn't buy it at this price?
Well, I might buy it at this price. As a general principle, I guess what I have to say is that I want to reduce the bet, but at the same time, I want to make certain that the bet I have left on the table is being used very actively and very aggressively. And I'm not afraid of secondary stocks and tertiary stocks, and I'm not afraid of having individuals who think of themselves as not particularly sophisticated in the stock market making their own decisions in here. I think if they're logical, I think if they look to some of the important trends, I think that they can do very well.
Let me turn you over to the active and aggressive Carter Randall.
Will, a lot of money's been made over the last few years by anticipating buyout situations, takeovers. Do you see that continuing, and is there still opportunity to make money that way?
Well, it probably will continue because these things never end when they should. Clearly, because the Fed has tried to dissuade it, and the uncertainty over the new tax bill, I think, is slowing it down. But there are still situations which will appear attractive, and I suppose people can make some money. I've never made any money anticipating these things. I need to buy stocks that I understand, that I can touch and feel, and which I can relate to, and I think the short answer is maybe, but I don't care. Okay.
Will, this week the Commerce Department came out with a couple of judgments against the Japanese for unfair trade tactics in the semiconductor industry, or in selling semiconductors in this country. The whole industry should benefit from that. But are there some smaller, low-priced or depressed semiconductor companies that will benefit more than others?
Well, there are, but you really don't even need them because the semiconductor stocks, on balance, haven't really done anything. I mean, I mentioned National Semiconductor. Intel is another stock which is a big stock, but which was right around these levels when the rally began. I think it was 25, and today it's 28 or something like that. Advanced Micro Devices, there's a small one that I especially like called Zycor, which trades over the counter. These are all California companies. And then there's something called LTX Corporation, which I think is especially interesting as well. And that's what we call a semiconductor capital goods company, but essentially a semiconductor company.
Well, you mentioned taking some bets off the table. Would there be some other investment areas that you think might be attractive for shifting some of those assets? For example, real estate or collectibles or some other asset categories?
No, I think you want to stay in the stock market, but I think it's a matter of timing, and I think it's a matter of where you want to be. And I think, Eddie, where you have to have your money now is in places where you can see these big earnings gains. In some of the capital goods stocks, there's a company called Ultra Systems, which is a cogeneration equipment company in San Francisco.
What's cogeneration? Father and son together? What's that mean?
Cogeneration is where you use, the short version of cogeneration is where you use one source of energy twice.
Well, we only have a minute or so left. Your firm is noted, you personally are noted, for bringing out new issues. If your analysis of the market is right, this isn't a wonderful time to be buying new issues, is it?
It's a wonderful time, Lou, because people are taking them to silly prices, and because they're available for the first time. And I believe that this week was a record week in terms of the number of new issues and the amount of stock that was issued.
Is that a sign of froth and of a market in need of correction?
Absolutely.
Are there any new issues that you would recommend at this point?
I'm not allowed to.
Well, they don't have to be your firms. you can be a big guy.
The answer is I would not.
How soon would you expect this correction? Do you think it may come as early as next week?
I do. I think it. There are just so many signs, and even if it doesn't come, I think that an investor is wise to say thank you to whichever deity it is that he or she observes, and walk away here with some money. And I think one of the keys here is to have some fun with this. And I think you have a lot more fun when you've taken some profits, and you're not so much at risk.
More fun than taking losses, I suppose.
Substantially.
How about later this year? How high is up?
I don't make any money in the averages, so I don't really know. I think
How
we're
about bonds?
pretty
Do anything
close.
with them?
No, I think interest rates are pretty close. I think we're going to get to a point, Lou, where bad news is going to be bad news and good news will be good news. And I think that when we see a massive jump in unemployment, that's going to be bad.
Wall Street won't be able to readjust to a logical world. I don't think they'll be able to handle that. Thanks very much, Will Weinstein. Thanks, panelists. Hope you'll be back with us again next week. Then we'll turn to the home front and talk with an analyst of housing stocks. He's John Stanley. And I'll ask him to open the door on your chances of turning the American dream into your investment castle. Don't miss this window of opportunity. It's a program around which you may want to build your Friday night. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.